Hello, 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 hello. I'm back with another stream. So, here, what we will be doing is that. Where is my thing? So, what I'll do is I'll quickly play a song in the background. So, today, my target is to finish this research paper, okay? Let's go to audio library. Playlist. Let's go happy music. That's a bit loud. I think now it's better. Comments, right? What the? Okay, now it's working good. So what are we talking about today then? Basically, stock index, interest rate, and gold price of Nepal, and then its co-integration and its casualty analysis. Okay, is there any? That's the big question, right? Is there any? That's the big question. How do I undo this, man? Where was it? Alright, I'll just use the shortcut key. Alright, so that is done. So it was written by Om Nath Vaide. Okay, interesting. There should be an undo button somewhere around over here. Where is it? Alright, anyways, I'll be prepared next time. So let's go down the page again. So what does this thing basically aims to do is that the study examines co-integration and casualty between NIPSE index and vice versa, short-term interest rate and gold prices in Nepal. Okay, so that's all right. And then what the main objective of this study is to basically identify the long run cause and effect or equilibrium relationship, as well as causal relationship between the variables under consideration. Okay, so main objective is that, and then after that monthly time series data cover the period starting from January 2006. Okay, that's the time frame to December 2016. So that is exactly 10 years, right? That will be 1 year, and then 2, 3, 4, 5, 6, 7, 8, 9, 10. And which are sourced from NIPSE, Rashtra NRV, and then after that Dealers Association. Okay, so the result of unit ADF test and co-integration Johnson test confirmed that there is long-run equilibrium relationship between NIPSE index, short-term interest rates, and gold prices in Nepal. In the meantime, Granger casualty test reveals that there is no casualty between gold price and NIPSE index. However, it is confirmed that there is unilateral relationship. Okay, so not both way, but unilateral relationship between NIPSE index and short-term interest rate. Okay, which moves from interest rate to NIPSE index. Okay, so interest rate to NIPSE index. Okay, so from here to, oopsie, where did I draw from? Interest rate to NIPSE index. Okay, so from the result, it can be concluded that short-term interest rates are better predicted for NIPSE index and Boolean commodity market as well, which is basically yet to be developed, right? Granger casualty co-integration. What does that say? Stock index, interest rate, right? So these are the keywords. JEL classifications are this. And then after that, configuration of Nepalese Industries, Kathmandu, NRV, economic review, right? Introduction. The primary role of capital market is to allocate the economy's capital stock among various productive sectors in means of a variety of instruments named financial securities. It was said by Fisher and Ronald. So basically is to allocate capital stock among various productive sectors in the means of varieties of instruments named financial securities. Right? The secondary role of capital market is to provide trading mechanism for such securities. Trading mechanism for such securities to ensure transfer of ownership and exit route for the investor. Similarly, as the marketability and fungibility are the common characteristics of any securities, it is essential to provide them a competitive price, discovery mechanism and liquidity. That's correct. Competitive price along with some mechanism which provides liquidity as well, right? So no modern capital market of any size can function effectively without such facilities at the lowest possible cost. This is done by well-organized public secondary market, also called the stock exchange. The stock exchange is an entity that provides mechanism for shareholders, investors and traders to trade stocks, bonds and other financial securities. Although the history of capital market in Nepal can be traced to the period of Rana regime, Nepali capital market is very small compared to its neighbors. So the organized secondary market in the country started in 1976 when the government established SEC, right? And then later on, I think to provide trading platform for financial securities. And then later on, it was converted to NEPSE in 1993, and SEC was only capital market institution, which was basically undertaking the job of brokering, underwriting, managing public issues, market making for government bonds and other financial services. The basic objective of NEPSE was to impart free marketability and liquidity to the government and corporate securities by facilitating transactions in its trading floor through member brokers and market intermediaries. Since 1994, NEPSE is regularly publishing the stock market index named NEPSE. What's the index? It's called NEPSE, along with other vital capital market indicators. The stock market has a central location at least for record keeping, but trading is increasingly less linked to such a physical place as modern markets such as electronic networks, which give the advantage of increased speed and reduced cost of transactions. Capital market in general and the secondary market in particular are highly volatile in nature. Capital market in general, it is highly volatile in nature, which has been equally applicable for the Nepali market as well. As a result, the stock market of Nepal, measured and indicated NEPSE index, has experienced many ups and downs during its journey of 2 decades. There are many factors which affect the stock prices and in turn the overall index. So many factors that affect the stock prices, which then affects the individual script, and this in turn affects the whole index itself. A loan that you've taken from a friend or something like that. Then after that, the price of substitute investment vehicles. So what's the price of substitute, right? So if the price is less, people would be attracted towards there as well. And then in the study, interbank lending rate is taken as cost of investable fund. Okay, so this is very important assumption. So interbank lending rate, nowadays it's very low. I don't know about those days, how it was. And the gold price is taken as the price of substitute investable vehicle. Okay, so investable fund would be, investable fund is interbank lending rate, and then after that in the substitute for that is gold, right? Bullion. Yep, that's what it is. And then the main objective of the study is to identify the long-run co-integrating equilibrium relationship between NEPSA index and short-term interest rate and gold prices. In the meantime, the study aims to gauge the cause and effect relations or causality between gold prices, interest rate, or vice versa to NEPSA index. There is no such studies. Since no studies are done so far in Nepali context, this paper will signify the need of tested predictive model for Nepali stock market and the stakeholders. Similarly, the findings of the study will serve as guidelines while making investment and trading strategies in the Nepali stock market. The remaining portion of this paper is organized as follows. The second section reviews the literature, while section 3 describes data sources and methodology used for the study. Okay, so is that second section, what does it do? It reviews the literature, while section 3 basically describes the data sources and methodology used. Okay, so method is very crucial for us. And fourth section will be empirical analysis and finding of the study, right? Final section is basically summary and conclusion. Okay, let's go to second section. So literature review. So various authors have studied different aspects of stock market with the help of different financial and statistical methods to analyze the performance of stock market behavior. And then most of the researchers have focused on the importance of econometric relationship. So they have focused on econometric relationship for forecasting as well as identification of co-integration and causal relationship between the stock market and economic indicators. Tian Ma 2010 employed the ARDL model. So what was this ARDL method? 2010, right? I saw something over here. ADF, that's what I saw. Not ARDL. Okay, so Tian Ma in 2010 employed ARDL model to study the co-integration and found that prior to financial liberalization of 2005. Okay, where are you talking about? So liberalization, because liberalization happened in Nepal around 1990s, right? Liberalization. So there was no co-integration between interest rate and prior. Okay, so prior to liberalization there was no co-integration, and then that means, so it's prior to liberalization there was no co-integration between interest rate and Shanghai Stock Exchange or Index in China. After devaluation, the co-integration found and money supply along with interest rates had affected stock prices. Positive correlation. Okay, they had found the previous month CPI, Granger Cousins stock indices. CPI Granger causes stock indices, making a departure from previous study in Sri Lanka. They found that the previous month CPI Granger causes stock indices. Okay, so Wakri Masinge established both short and long-term causal relationship between. Who was this guy? Wakri Masinge, making a departure from previous study in Sri Lanka. Alright, so what did this guy have found was short-term and long-term causal relationship between stock indices and macroeconomic variables, right? And then bidirectional causal relationship were found from stock indices to consumer price index. Whereas in this case, what has happened? CPI is the cause for stock indices, right? Stock changes, changes in stock, right? So in this case, there was a bidirectional kind of thing, and then the ASPI to the narrow money supply and ASPI to short-term interest rate. Okay, and Tentative and Kobe in 2007 used unit root. So what did they use? Unit root, ADF. Co-integration and Granger casualty test in Thailand, and found that the stock market, stock index, industrial production index, money supply, interest rate and gold prices were having co-integrating relations. Stock index, industrial price thingy, money supply, interest rate, gold prices. Okay, so using monthly data from 2004 to 2010, Parsva and Lei modeled the stock index with interest rate, inflation and oil prices in Egypt, Iran, Kuwait, Oman, Saudi Arabia results. So in short and long term, there is bidirectional relationship between stock prices and interest rate for Egypt, Iran, Oman before the crash. Kuwait, casualty runs from interest rates and oil prices to stock prices. In that case, there was unilateral, there was bidirectional casualty, right? In this case, there is interest rate and oil prices, and then only it goes to, or the casualty runs from these things to stock prices, right? Sarvama Indra and Mandip evaluated the long-term relationship between BSE and macroeconomic variables. Like what? Like exchange rate. Exchange rate is also coming. Okay, foreign exchange reserve is also coming. Inflation rate, gold prices. The study proved that domestic and international gold prices were co-integrated with Indian stock indices. Okay, international gold prices as well, domestic and international gold prices. Piazzetta Philosophy and Babbe revealed that there is a negative association between gold prices and stock prices. Iran, negative. When the price of gold goes up, stock goes down, right? They examine the impact of interest rate and house prices on stock market on monthly data from March 2001 to April 2011 using VAR and Johnson co-integration model, and found that most of the fluctuations in the stock market were explained by selected variables. However, the house price had main role on stock price fluctuations. Smith examined the short-term and long-term relationship between 4 different macroeconomic variables: and gold price, vice versa, 6 different US stock indices over the period of 1991 to 2001, so 10 years, right? For macroeconomic variables and gold prices. And then what did he report? He reported no long-term relationship or co-integration between a gold price and stock index. How can that be? There were, however, some evidence of short-term casualty running from interest rate to US stock market or stock indices, right? But not reverse. Important thing. Not reverse. So by using monthly data from 1986 to 2007 in Japan, Lee and Chang 2011 found long-term relationship as well as bilateral causality between interest rate and stock index in Japan. So bilateral causality between interest rate and interest rate and stock indices index. Sajdi and Chauhan, wherever that is. So the impact of gold prices on Karachi Stock Exchange, right? Impact of gold prices on that, right? Gold on stock. Okay, so by using monthly data, and then they found perfectly negative relationship between monthly average gold prices and Karachi Stock Exchange 100 index. In contrast, monthly time series data of Mumbai gold prices and 3 stock index which is basically Sensex, BSE 100, S&P CNX Nifty were co-integrated, confirming a long-term equilibrium relationship among the variables. Right, between the 3 of them, right? 3 stock market data and gold prices and stock prices. So Tiwari and Gupta tested. So when did this guy do? Patel 2013, right? Because 1990s data can't be trusted from BSE. It was part of manipulation. Tiwari and Gupta 2015 tested the causality between gold prices and vice versa of BSE Sensex and found that stock market was sensitive to both domestic and external factors, and one such factor was gold prices. So in Nepali context, REG in 2012 examined causal relationship between NIPSE and economic growth in Nepal for the year 1994 to 2011. So what's that? 17 years, right? So what method did we use? Unit root method, co-integration and vector error correction model for NIPSE composite index. The findings suggest there is a bilateral relationship between NIPSE index and economic growth. For the review period, Shrestha and Subedi examined the determinants of stock prices, stock market performance in Nepal using monthly and growth of money supply, negative response to interest rate. From the study, NIPSE index had been found to be influenced by political and NRB policy. NRB's policy. The positive outlook for political stability has positive impact on stock index. Positive outlook. Similarly, change in NRB's policy on lending against collateral of share has significant, if you look at the word, significant impact on the movement of stock prices. very sensitive, right? Data and method in this study and experimental research design has been used so as to make the collection, analysis and interpretation of secondary data easier and wide drawing conclusions. Since the study is concerned on the secondary market of Nepal and has made an attempt to model the NEPSE index with respect to short-term interest rate and gold prices for the period of January 2006 to December 2006 using monthly data. Okay, I made an attempt to model NEPSE index with respect to short-term interest rate and gold prices. So NEPSE index. NEPSE is a value-weighted index of all shares listed in blah blah, calculated once a day at the closing price. The basic equation of NEPSE index is defined as NEPSE T and then MC thingy into IB. NEPSE T is like NEPSE index at current time. MCT is market capitalization of all listed stocks at current period divided by, I think, yeah, current period, and then it's divided by base, right? And then that is multiplied by 100. And we know that already. The standard NEPSE index is designed based on weighted market capitalization method, where stocks with the largest MC market capitalization carries the greatest weight, right? Which is making the value of the index very vulnerable to the price movement of such dominant companies. Interesting point, huh? So the value of the index is very sensitive to the price movement of dominant companies, right? Like analyzing NTC, CIT, so interbank rate. So this is the rate that has been taken, okay, for what was that, for like cost of fund. Interbank rate is one which is charged by one bank to another interbank market to manage day-to-day liquidity and meet the regulatory requirement. The average rate data of interbank rate is taken from Quarterly Economic Bulletin of Nepal Rashtra Bank. Okay. And gold prices, of course you have to make some assumptions as well, right? But nowadays I think you can measure it based on average lending rate of bank against shares, right? Gold prices. Gold is considered as a safe investment vehicle, so it's a safe haven and used for hedging against the price risks across the world. Investors thus buy gold as a way of diversifying risks, especially in the forms of futures, contracts, and derivatives. So since we don't have both of these derivatives, in order to assess the relationship between gold commodity and capital market in Nepal, end of the month, gold prices have been used. The source is basically this association, right? So the econometric model that is used is basically, so an economic model is used to complete if it contains, just I have explained the following form of basic root tests. So what have they explained? Consider some autoregressive one process, so yt equals to yt minus 1 plus xt blah blah, so where xt are optional use, I think it's external factor, right? Exogenous regression, which may consist of constant as well, or a constant and trend, and then p and whatever this sign is are parameters to be estimated, and then it is basically assumed to be white noise, okay? So series y is non-stationary series, so greater than 1, right? P greater than 1, modulus p could be negative as well. the variance of y increases with time and approaches infinity. The variance of y increases, and series y has a trend minus stationary process will be basically p will be less than 1. So if the trend will be less, let's see this what it does is that, so if it's non-stationary, so that means it's dynamic, right? So it will be +1. Whereas if it's stationary kind of thing, it will be less than 1. So thus the hypothesis of stationary can be evaluated by testing whether the absolute value of p is strictly less than 1 or not. So whether it is less than 1 or not. It basically gives us whether it is stationary or non-stationary, right? Non-stationary. So the standard Dickey and Fuller test is carried out by subtracting yt minus 1 in both sides of the equation 3. Okay, so from both sides. So that means we get a delta, right? That's the change. So where alpha is basically p minus 1. So p could be less or greater than 10, yes, 1, right? 1. The null and alternative hypotheses are respectively, so where null hypothesis is alpha is equals to 0 and alpha is less than 1. So when does that happen? So if p is, let's say, 2 minus 1, it will be 1, right? And then if it is 1 minus 1, it will be then, and then if it is, let's say, p is minus 0.5 minus 1, so that means it will be minus 1.5, right? So the hypothesis can be evaluated using t-test. The sample should be less as well, I think. T alpha, a hat, standard error, I guess, where a hat is the estimated alpha, and then standard error is the alpha is the coefficient standard error of a hat. Okay, that's the standard error. I was right about that. Okay, good. The simple Dickey-Fuller unit root test described above is only valid if the series is an AR. If the series is a simple autoregressive, right? And if the series is correlated at higher order lags, the assumption of white noise disturbance ET is violated. And so if the series is correlated at higher order lags, so there is a lot of lags, right? So this means noise disturbance is violated. So in order to cope with augmented Dickey-Fuller test has been constructed with parametric correction for higher order autocorrelation by assuming for higher order autocorrelation, right? By assuming that the series Y follows an AR process. So adding p-lag difference terms of the dependent variable y, the ADF test follows the following process. So delta y equals to alpha yt minus 1 xt. I don't know what that symbol is. And then beta 1 delta yt minus 1. Okay, so this showing the change, right? And then again change kind of thing. So just dot it up. So that's the equation. So augmented specification is then used to test the above mentioned hypothesis using the t-test ratio of 3.2. here. So co-integration test. The purpose of the co-integration test is to determine whether the groups of non-stationary series are co-integrated. There are a number of methods for testing the co-integration. As explained below, the presence of co-integrating relation forms the basis of vector error correction model. So co-integration test, what happens? The purpose of co-integration is to determine whether the groups of non-stationary series are co-integrated. Non-stationary series are co-integrated, right? So whether they are together or not. Number of methods for testing this. So as explained below, the presence of co-integrating relationship between the basis of the is vector error correction model. Here VAR based co-integration model are performed using methods developed by Johnson. So consider a VAR of order P, yt equals to a1 yt minus 1, and this could be yp and t minus p. Right, and then where yt is the k vector of non-stationary I1 variable, xt is the t vector of deterministic variable, it is the vector of innovation. So we may rewrite this variance as delta yt, and then after that okay. So again type another, so where the symbol is that e and then I equals to 1, so ai minus I equal. So Granger representation theorem asserts that if the coefficient matrix has reduced rank, this is R is less than K, right? Then there exists K into R such that whatever this is equals to alpha into beta, right? So beta is R0 here. R represents the number of co-integrating relationships. The co-integrating rank K is the number of exogenous variable, and each column of B is the covariant. I think there is some word over here, I can't read it. So it's using VR model, right? Then Johnson proposes two different likelihood ratio tests of the significance of this canonical correlation, and thereby the reduced rank of the two metrics, the stress test and maximum eigenvalue test. So in the equation below respectively, so J stress, and this is the equation 4.2, 4.3. It is the sample size, okay, good. So largest correlation, the stress test tests the null hypothesis of R co-integrating vectors against the alternative hypothesis of N. So maximum eigenvalue test the null hypothesis of R co-integrating vectors against the alternative hypothesis of R plus 1. So Granger causality test. Correlation does not necessarily imply causation in a meaningful sense. That's correct. If there is a correct correlation, does not mean that's the one that is causing it, right? Another very important thing. The econometric graveyard is full of magnificent correlations which are simply spurious and meaningless. The common practice in testing the direction of correlation between two variables in Granger causality, the series Y is said to be Granger caused by series X. The series Y is basically caused by X if X helps in predicting Y. That's correct. or equivalently if the coefficient of the lagged x or if the coefficient of the lagged x are statistically significant. So if the coefficient of the lag x are statistically significant, okay. So similarly, two-way condition is a situation where x causes y and y causes x. However, it is important to know that the statement x Granger causes y does not imply that y is the effect or result of x. However, it is important to know that statement x it just does not mean it causes that, right? In case of two-way causation, or y is the effect or result of x. So Granger causality test measures precedence and information content, but does not by itself indicate causality in the more common use of the term. The mathematical formulation of Granger causality test is based on linear regression model of stochastic processes. So for illustration, consider a bivariate linear autoregressive model plus two variables x1 and yt, although more complex extension to nonlinear cases exist. That's that. So where M and R are maximum number of lagged observation of respective series. So M and N are maximum number of lagged observation of respective series included in the model. The model order, the matrices B, Y, B and C contain the coefficients of the model, the contributions of each lagged observation to the predicted values of x, t, y, t. Finally, contain the coefficients of the model which helps to predict that. And finally, UTBT are residuals or prediction errors for some each time series, right? In this model, Granger causes xt if the coefficients in y are jointly significantly different from 0. So in yt, xt causes yt Granger causes xt if the coefficients in yj, right, yj are significantly different from 0. Similarly, xt Granger causes yt if coefficients of cj is basically are jointly significantly different from 0. This can be tested by performing an F test of the null hypothesis, which is yj equals to cj equals to 0, given assumptions of covariance, stationarity on xt and yt. The magnitude of Granger causality interaction can be estimated by logarithm of corresponding F statistic. In order to determine the appropriate order in the model, selection criteria such as Bayesian information criterion (BIC) or alkaline information criterion can be used. So what was the result and analysis? So you need to test. So ADF is a common in identifying stationary feature of a time series. So stationary feature of time series. So in this study, the test has been performed to examine the unit root feature of 3 time series comprising 3 time series, right? So it is comprising of Neptune index, gold and interest rate. The test result confirms all the 3 series of the data are non-stationary. Okay, it just confirms that they are not stationary. However, they have become stationary at the first difference. This has proved has the null hypothesis, stationary at the first difference, and then there is unit root in the data series rejected at 5% level of significance. So the result of area of test have been presented in the following table. Okay. Okay, what's the at level thingy? Ability degree test. Fuller test, right? The statistic is this. For gold, interest rate is this. NEPSI is this. P-value is that. 0.11, 0.06, 0.19. These statistics this. P-value that. As all the data series have become stationary at the first difference, further analysis of this data series is permitted. Co-integration test, Eagle and Granger pointed out that linear combination of two or more non-stationary series may be stationary. Two or more non-stationary series may be stationary of linear combination. In such a case, the non-stationary time series are said to be co-integrated, which is interpreted as long-run equilibrium relationship among the variables. The commonly used integration tests, as suggested by Johnson, are unrestricted co-integration rank test and unrestricted co-integration rank maximum eigenvalue test. Right. So in the study, the critical values of both trace and maximum eigenvalue test reject the null hypothesis of no co-integrating relation at 5% level of significance. Okay, that's important. So what does it do? It rejects the null hypothesis of basically that there is no co-integrating relation at 5% level of significance, right? To rejects that, so that means there is a relationship, right? So McKinnon p-values of both the tests confirm at least one co-integrating equation in the model. Hence the long-run equilibrium relationship between NEPSI index, vice versa, interest rates and gold price is confirmed. The following table summarizes the result of Johnson co-integration test, right? Co-integration test, what is this? Eigenvalue is this, at none, at most 1, at most 2 is that. This test is this, 36, 11. Critical value is 29, 15, 3. Similarly, for maximizing value is basically what's there, statistic 24, right? 9.74, 1.92. So what is the critical value comparison with the other thing, right? And that's what I am interested in. Calculated value is greater. Since the value is basically greater, so rejected vector error correction model VCM is one of the most successful, flexible, easy to use model in a rising multivariate time series. The time error correction relates to the fact that long periods deviation from long run equilibrium. The error influences its short-term dynamics, imposing known unit tropes and known co-integration restrictions. VCM may prove the power of statistical tests such as Granger casualty test. In this study, the EC model is estimated to reconfirm the co-integrating relationship among the variables under consideration and to gauge the long-run casualty between NIPSE index, vice versa, interest rate and gold prices. In order to estimate the VCM 1PA differences selected as indicated by AIC and PIC lag order selection criteria, and the results are given in the table below it. As such, this statistic which just basically indicates it's not our hypothesis is rejected, right? Null hypothesis is rejected. So the result of VCM shows there is co-integrating relationship among the variables under consideration. This is confirmed when the value of these tests have been significant and indicated by the standard error. The coefficients of co-integrating equation 1, the results also indicate that there is causality between NIPSE index and interest rates, as well as gold prices and interest rates. So it is observed that interest causes to change both NIPSE index and gold prices, whereas NIPSE causes only gold prices. Interest causes to change NIPSE index, and gold price just basically causes to change both of them, right? Gold prices and index, NIPSE index, whereas NIPSE only causes gold prices, but gold prices does not cause to change NIPSE and interest rate. That is correct. Although the relationship are statistically significant as indicated by SCLT test, the causal relationship between the variable and the direction of the impact is reconfirmed by pairwise Granger causality test. Granger causality test. According to Granger 1969, series X causes Y if the past values of X can more accurately predict Y if the past values, right? If the past values of Y can accurately predict Y, then simply the past values of Y. If the past values of Y causes X causes Y, then the only values of only past values of Y, right? In simple words, if past value of X improves the prediction of Y with statistical significance, then we can conclude that X Granger causes Y, right? So here Granger causality test has been performed to check the direction of causality between NIPSE index and interest rate, as well as NIPSE index and gold prices. The result of pairwise Granger causality test have been summarized in the table below. So, okay, So it is found that causality moves from interest rate to NIPSE index as p-value of corresponding F statistic rejected the null hypothesis, that is interest rate does not cause. So what did happen? So does not cause Granger, does not cause Granger interest index. Yeah, I mean NIPSE index at 5% level of significance. H naught over here was what? Interest rate does not cause NIPSE, right? So this was rejected. At 5% level of significance. Basically it was significant, right? Yeah. This is obvious since secondary market is guided by short-term interest rate prevailing in the financial system. So however, no causality is found from NIPSE index to interest rate. So basically this was interest rate to NIPSE. It's not there, and then the other thing was NIPSE to interest rate. Does not Granger cause interest rate have been accepted by p-value corresponding F statistic. In the meantime, no causality is found between NIPSE and gold prices as well as gold prices and interest rate. So pairwise causality test. What is this? No, like this rejected since it is statistically significant, right? So interest rate does not going to cause NIPSE index. Since it is not significant, so H hypothesis accepted, right? Okay. Gold prices that's correct. Gold prices interest rate does not Granger cause gold prices, that is correct. So only this thing is null hypothesis is only rejected over here. So what was the hypothesis? Is interest rate does not Granger cause interest NIPSE index, right? So Indian interest rate does Granger cause NIPSE index, right? So that has been proved. Conclusion. So what's the conclusion? The study examined co-integration and causality between NIPSE index, vice versa, short-term interest rate and gold prices, with an aim to identify the long-run equilibrium association as well as the cause and effect relationship between the selected variables. For this monthly time series data of all variables from 2006 January to 2016 December have been used. Based on the result of the unit product test and co-integration test, it is confirmed there is long-term equilibrium relationship between NIPSE, short-term interest rate and gold prices in Nepal. In the meantime, the ECM estimate indicates the interest rate caused both the NIPSE index and the gold price in the long run. That one does, right? Both NIPSE and gold price, NIPSE index cause the gold price. However, it is not confirmed by pairwise Granger causality test. From the pairwise Granger, it is confirmed that there is unilateral causality between NIPSE index and short-term interest rate, which moves from unilateral casualty only, right? Which moves from interest rate to NEPSA index. It means the stock market of Nepal is sensitive to country's financial system, and short-term interest rate has been one of the major determinants of stock market represented by the NEPSA index. Thus it is concluded that short-term interest rate could be one of the predictors of stock prices in the secondary market of Nepal. Since the causality between gold vice versa NEPSA index and interest rate is not confirmed, it is concluded from the finding of the study that the country's commodity market is not yet developed well enough to provide alternative investment vehicles as a substitute of secondary market, right? Because there is no causality between gold prices and NEPSA index and interest rate, right? So all of these references were used. All of this are the data. 2016, 2006, okay, monthly time series, NEPSA index, interest rate, gold prices. Yep. Alright guys, that's pretty much it for the day. I will see you next time. Until that time, have a good one. Take care. Bye bye.